The market is currently closed. As of the final bells on January 12, 2026, Rezolve AI PLC, trading under the ticker RZLV on the Nasdaq, sits at exactly 4.01 USD. This represents a substantial intraday climb of 8.97%, with the stock moving up 0.33 USD during a session that saw it touch a high of 4.13 USD and a low of 3.66 USD. While most traders are looking at this 4 USD level as a psychological resistance point, the truly startling insight hidden behind the ticker is a massive disconnect between what the market believes this company is worth and the actual contracts already signed on the dotted line. While the current market capitalization hovers around 1.34 billion USD, the management team recently revealed that they have already secured over 209 million USD in contracted revenue for the 2026 fiscal year alone. This figure is not just a projection, it is a committed reality that exceeds the average analyst consensus by nearly 40 million USD. This creates a rare situation where a small-cap technology firm is essentially being priced at a fraction of its visible secured growth, setting the stage for a dramatic correction in value once the broader market realizes the scale of the discrepancy. The general market expectation for Rezolve AI has long been one of skepticism, with many viewing it as just another participant in the crowded intelligence software space, riding the coattails of larger titans. Investors often assume these smaller firms are burning through funds with no clear path to profitability, merely hoping for an acquisition. However, the reality of the situation is far more robust. While the crowd waits for proof of concept, Rezolve AI has been quietly embedding itself into the infrastructure of global retail through its Brain Suite. They are not just building chatbots, they are creating autonomous commerce agents that handle everything from visual search to final checkout. The common ground among retail investors is the belief that the stock is undervalued, but the contrarian take is that the volatility we see today is not a sign of weakness, but a sign of a massive tug of war between high-conviction retail holders and aggressive short sellers who are currently trapped in a position that is becoming increasingly expensive to maintain. Looking at the recent trading activity, the volume has been nothing short of explosive. On January 12th, we saw tens of millions of shares changing hands, well above the 90-day average. This institutional-level activity suggests that these smart funds are beginning to accumulate ahead of the major analyst and investor call scheduled for later today, January 13th. The stock has been showing a classic accumulation pattern, bouncing off its 52-week low of 1.07 USD and grinding its way through previous resistance levels. What's fascinating is how the price action responded to the Microsoft partnership demonstration at the NRF 2026 event. Instead of a sell the news event, we saw sustained buying pressure. This indicates that the demonstration of their agentic commerce solutions, which allow AI to curate outfits and complete transactions autonomously, has finally given the market a tangible reason to believe in the business model. In the trenches of online investing communities on platforms like Reddit and X, the sentiment is reaching a fever pitch. There's a palpable sense of frustration among retail investors who feel the stock has been unfairly suppressed by short interest manipulation. As of the latest reports, nearly 31% of the public float is sold short. This is an incredibly high figure that often points to a potential squeeze if the company continues to deliver positive data. Retail traders are sharing screenshots of their portfolios, calling out what they perceive as ladder attacks designed to keep the price below the 4 USD mark. There's a deep-seated belief that hedge funds are trying to force a panic sell before the 2026 revenue guidance is fully digested by the public. This emotional tug-of-war is driving the intraday swings as disbelief from the bears meets the unwavering confidence of the diamond hand retail crowd. The institutional positioning tells a different story than the social media chatter. Analysts from firms like Cantor Fitzgerald and Maxim Group have maintained aggressive buy ratings, with price targets ranging from 8 USD to as high as 15 USD.
When a stock is trading at 4.01 USD, while experts suggest it could triple or quadruple, you have to ask why the gap exists. The answer usually lies in risk perception regarding the company's history of cash burn and the complexities of its past corporate structure. However, with the recent announcement that December revenues exceeded 17 million USD and the path to a 500 million USD revenue run rate by 2026 is clearing up, those risks are being mitigated in real time. The institutional activity we are seeing now is likely a repositioning by funds that realize the sell-side narrative is starting to crumble under the weight of actual earnings growth. To understand why this stock is moving this way, you have to look at what they actually do. Rezolve AI provides a platform that essentially turns any mobile device into a high-powered personal shopper. Their brain suite uses multimodal intelligence to understand intent, allowing a customer to point a camera at an item and have the AI not only find it, but suggest a full outfit and execute the purchase. This is a massive shift away from the traditional search and click model of e-commerce. By partnering with companies like Microsoft and Fashable, they are scaling this technology across enterprise retailers who are desperate to increase digital conversion rates and reduce cart abandonment. Their business model is shifting towards a recurring revenue stream backed by high-margin professional services, which is exactly the kind of financial profile that attracts long-term institutional backing. The tension between expectation and reality is most visible in how the market reacts to their updates. For example, when they announced the new SQD revenue model, many retail traders were confused by the technical jargon, leading to a temporary dip. But the reality was that this model provided a much more stable and predictable income stream, which the sophisticated investors recognized immediately. This pattern of retail confusion followed by institutional buying has become a hallmark of RZLV's trading cycles. It creates a high-stakes environment where those who understand the underlying technology and the contract values are able to profit from the volatility created by those who are just trading the ticker symbol. Please comment below how many shares of Rezolve AI you currently hold and what your personal price target is for the end of the 2026 fiscal year. As we look toward the immediate future, all eyes are on the analyst call scheduled for January 13th. Management has explicitly stated they intend to reset expectations regarding their 2025 and 2026 revenue guidance. This is a bold choice of words, which usually signals a massive upward revision. If they provide a clear, data-driven roadmap for how that 209 million USD in contracted revenue will hit the balance sheet, the current $4 price might soon be viewed as a historical bargain. However, the risk remains that the market could find some detail to be disappointed in, perhaps around the timing of deployments or the continued cash burn required to scale. The psychological battle here is whether the market will finally reward the company for its results or continue to treat it as a speculative play until the net income turns positive. The sentiment in the coming weeks will likely be dominated by how the short sellers react to this week's news. If the price manages to hold above 4 USD and begins to test the 4.50 USD level, we could see a cascade of covering that provides a secondary boost to the stock price. This is the scenario that the retail community is banking on. On the flip side, if the guidance is seen as priced in, we might see a period of consolidation. Regardless of the short-term swing, the fundamental reality is that Rezolve AI is no longer just a startup with a dream. It is an enterprise software provider with hundreds of millions in contracted revenue and partnerships with the biggest names in technology. The disconnect is shrinking, and as it does, the volatility is likely to remain high. In summary, the story of Rezolve AI at this moment is a classic case of a company outgrowing its market reputation. The expectations were set low during a period of corporate transition and high short interest, but the reality of their 2026 revenue visibility is forcing a reevaluation. We have moved from a period of speculation into a period of execution. The jump to 4.01 USD on heavy volume is a signal that the market is waking up to the contract values that have been hidden in plain sight. While retail investors remain frustrated by the daily fluctuations, the data suggests that the institutional floor is rising. The contrast between the 30% short float and the $209 million in secured revenue creates a spring-loaded setup that could define the first half of 2026 for the software sector. The authority of this analysis rests on the fact that we are not just looking at a chart, we are looking at the math behind the business. When the contracted revenue of a company is a significant percentage of its total market value, the downside risk starts to look very different than it does for a pure hype play. Rezolve AI is proving that they can deliver at scale, and as they do, the narrative will continue to shift from if they can succeed to how fast they can grow. The upcoming call will be the ultimate test of this transition, and the way the price handles the fallout from that event will tell us everything we need to know about the next phase of this company's life on the public markets. Would you like me to analyze the short interest data more deeply, or perhaps look into the specific details of their Microsoft partnership for you?